Welcome everybody. Thank you for joining us this afternoon. I feel very honored to have three gentlemen from Brown and Rudnick. We got Adam, Sam, and Michael. But before we start, I'd like to remind you, I'm sure that you guys receive our email blast that the Rosemont Innovators application is open. The deadline to apply is April 12th. We have amazing partners who are providing a lot of their in-kind services, and actually Brown and Rudnick is one of our in-kind service partners. And we also team up the selected company with pitch coaching, as well as executive advisors matching, and also we invite our network of early stage investors to hear your pitch presentation. So again, application is April 12th. You can go to our website to learn more about it. It's rosemontinstitute.org. And with that, let's get this going, because there's a lot of exciting things that Michael's going to share with you. So today's topic is venture financing. As you know, every one of you who are in startup world, funding is very important. And Michael will share with you what are all the things that you need to worry about or think about. What aspect when you get funding from investors are something that you can push back, is something that investor would never, this is a must have, and knowing what that levers that you have, I think that will be very useful. So with that, let me introduce Mike, quickly introduce Adam, who is a partner at Brown and Rudnick. He's an IP specialty, and then Sam is all corporate. Sam is also a partner at Brown and Rudnick. He is the specialty is in a corporate law, legal activity. And then for the star today is Michael Cohen. He has advised a lot of companies in the early stage, mid-market companies, and also worked with representing venture, hedge fund, private equity funds, you name it, funders in funding companies. And so he'll tell you more about, what he's seen, the pitfall that people went through. And so hopefully you can avoid some of that pitfalls from him. So with that, please take it from here, Michael.
Wonderful. Thank you, Christine. And thank you everyone for joining today. So again, my name is Michael Cohen. I'm a partner in the corporate and capital markets group at Brown Rudnick. I'm headquartered in our Boston office. And my colleagues, Sam Williams and Adam Schoen, are also out of our Boston office. As Christine mentioned, Sam, like me, is a corporate deal junkie. He's done his fair share of venture financings, and Adam is a specialist in our IP group. And I can't think of a deal I've done in recent memory where Adam or one of his colleagues and I haven't worked hand in hand in connection with the financing itself. And I'll talk a little bit more about that in a moment. But again, you can see the title of my presentation today is Financing Your Company, Picking Your Spots and Playing to Win. And when I thought about a title for this, I certainly wanted something catchy, and I think I've done that. But I think that what really came to mind in thinking about this is how overwhelming the financing process is. And I've been working in this space for 15 years or so, and I've done dozens of deals for both companies and investors. You learn something new on every deal. And there are lots and lots of different ways in which value can be extracted, and where both sides can claim victories. And it's really a function of understanding what it is that the investors are looking to do, and making sure that they understand where you are coming from so that you have the best chance of aligning on the things that that will ultimately make for a successful investment on the part of the investor, and will take you where it is that you want your company to go. And so that's again why I think that picking your spots and playing to win are really the key. They are key key themes in talking about financing your company. So again, Christine's already done a little of this, but I will very quickly once again introduce you to your friendly neighborhood lawyers from Brown Rudnick. And again, you see some snappy shots of us. I've managed to take some of the hair off of my head and put it on my face over the last couple of weeks. But such is life in the world of the pandemic. So our contact information is here in case you have any questions or have other items you want to run by us. We're usually pretty prompt. It's one thing you can count on lawyers for, is to be reasonably prompt with our emails. So I would urge you to just keep this in mind. This slide will come up again at the end, and we're always happy to point entrepreneurs in the right direction. It's very much part of what we do. So let me give you some preliminary thoughts about how I'm going to go about presenting this information today. The first thing that you should expect is that we will not be giving out law degrees at the end of the presentation. And what do I mean by that? Well, again, as I mentioned, I've been doing this for 15 years. Sam's been doing it for slightly longer. The truth is, it's very hard to become an expert on venture financing, having only done a few deals. I've done, as I say, dozens of deals, possibly hundreds. And the truth is, I'm still learning with every deal. And deal terms change and preferences change. And by that, I mean the things that are important to investors and the terms that that people find that they can't live without, they evolve over time. And so, today's presentation isn't meant to make you an expert in venture financing. And so that's what I mean when I say there are no law degrees being given out today. But what today is meant to do is it's meant to give you a sense as to the things you should be thinking about, so that when it's your turn to seek funding, you're prepared and when you've reached a point where additional help or guidance might be desirable. The second point is that Google is your friend, but not your counsel. And it's probably better said by saying Google is your friend, but not your advisor, right? There is lots and lots and lots and lots of writing and commentary about the financing process that you can find online. And there are some people who really, really know what they're talking about. The likes of Brad Feld from the Techstars program, and the folks behind Y Combinator. Again, there's just an incredible amount of commentary, that some of which is really, really helpful and insightful. Use that as a guide, and use it to inspire your thinking. But at the end of the day, there really isn't a substitute for having a real live person who can help you take your specific circumstances and apply them to options for financing, because at the end of the day, it really is, you can see in my next point, financing is not one size fits all. There are different factors that go into developing a strategy for how you're going to get yourself funded. I mentioned again that it's not a one size fits all thing, and really the next two categories of topics really fit into that. On the one hand, planning for financing starts at the earliest of corporate stages, and I note it here as formation, right? So when you're deciding, for instance, what kind of entity you should use, whether you should form as an LLC or a corporation, if a corporation, should you even consider being an S corporation? Should you stay with a C corporation? What jurisdiction should you form in? Should you form a California entity, a Delaware entity, somewhere else? All of this goes to what is it that your investors are going to want to see, because the choice of entity goes to how it is that your investor is going to hold their interest in your company. And there are different tax consequences to different forms of structure. So it's you can't start thinking about your investors' desires, if you will, early enough. And anyone who's done work in this space can help push you in the right direction for a structure that's going to work for you now and later. And then secondly, of course, there are many different ways to bring in funding. There's straight debt. There's convertible notes. Convertible notes are debt that ultimately converts into some form of security, typically shares of your company's stock. There are safes, which are incredibly popular now, and which I happen to like a great deal. And that's not to say that they're perfect for everyone, but it's a very, very efficient way of raising money. And believe it or not, sometimes lawyers can actually help you move in an efficient direction, and can actually save you a fair bit of cost. Particularly as you think about how to structure your financing and who it is that you're going after. There are certainly ways to do this both quickly and efficiently, and the right advisor can point you in the direction of something that will not only work in your circumstances, but can also be executed very quickly and very cost effectively. And then finally, the old classic is preferred stock. And this is where the majority of your professional venture capitalists, this is the instrument that they'll prefer the most. And then finally, I'll run through these quickly. So how you approach your financing your company depends on a number of factors, right? We've already talked about things you should think about as you're forming, but also, again, in making the decision as to which approach to take, which instrument to use, what kinds of investors to target. All of these things are important. Stage of your development. Your business category. Are you a life sciences company? Are you a high-tech company? Are you consumer-facing? Are you B2B? Are you SaaS? Right? All of this goes to what is the most appropriate instrument and who is best suited to be my investor. The amount of money you're looking to raise. Some investors won't look at you if you're looking at raising less than $15 million or more. Some investors cap their investments at 500,000. Your capital needs go into choosing a strategy. The number of rounds you expect to raise. Are you planning to raise one round and after that you'll be cash flow positive and profitable? Or is the round that you're looking to raise just one of many rounds that you'll need to raise before you can get to that point where you've either reached the pinnacle that you want to reach, or you've reached a point at which you're a viable acquisition target for another company or a private equity fund. And then again, that goes to the exit strategy, which is the next point, right? What is your plan? Are you raising so that you can run your business indefinitely? Are you raising to sell? Are you raising to go public? What's the end game? Because that's super critical as a means of helping your investor understand how the dollar that they're giving you is going to turn into 5 or 10 or 50, and how long it's going to take for that to happen. And then there's, of course, the other stuff, right? And other stuff is exactly that. Particular sensitivities you have, either based on your industry or your trajectory. And these are all things that someone who's been around the block once or twice can help make sure that you're evaluating properly and developing a strategy that will lead to success. So financing sources, and also I should say, I'm going to go through a few of these slides, and at some point I'm going to come to a reasonably decent stopping point, at which point I'll solicit questions, and my colleague Adam will be going through those questions and elevating questions that he believes are are ripe for this forum. But again, as I said, we've published our contact info, and you should feel free, if you don't get your question answered, shoot it along. More than happy to pick this up after today. So just the different flavors of financing that you may find yourself considering. There are non-dilutive resources. So these, for example, grants. The challenge with these is that typically grant funds need to be used in a particular way. So you're going to have, you're going to have strings on those funds, and there are things that they can't be used for. And it all depends on the term of the grant. So non-dilutive funding is wonderful because it doesn't reduce your ownership percentage, and yet there's only so much that you can do with it. So that's non-dilutive. Angels and friends and family. So some businesses lend themselves to relatively small rounds of investment. And that's typically because the overhead and the other costs associated with taking your business forward are not particularly capital intensive. If you're in one of those businesses, an angel or a friends and family round may be a great way to line your pockets early and help you achieve that which you're looking to achieve. Now, one of the things I'll discuss later is that it is never desirable to raise money at a time when you are desperate. And this goes to the timing and kind of having reasonable expectations around your raise. You never, ever want to be approaching investors at a time when you are on your last legs or you are desperate to bring money in the door. And so you really can't start your effort early enough. And even more than that, you should have some level of working capital that is able to sustain you for at least twice the amount of time that you think it's going to take you to raise, and maybe even more than twice. Because these transactions, no matter what they are, always take longer than you think. And you never want to be in a place where you have to sacrifice rights in exchange for speed, right? So it's always better to raise before you actually need it. Now, what does that mean at the outset? At the outset, it means you may need to raise friends and family money so that you've got enough to keep the lights on while you're searching for other funding, right? Because it's true, you never ever want to be in a place of desperation. So that's a little bit about friends and family. Venture capital itself, I've got a note here that it is definitely the most expensive capital you raise, and that is true. And it's true for a variety of reasons. And I'll actually hit those on a subsequent slide. And I promise I'm going to stop soon so that we can take a question or two. But relatively speaking, venture capital is among the most expensive money that you will ever raise, that you will ever see. And the reason for that is that typically venture capitalists are, their business is very simple. They need to take the dollar that a limited partner has entrusted with them and turn it into $5, $10, $50, $100, right? Over a certain period of time. That's their job. Part of that means finding companies like yours, putting their money to work in it, and retaining enough control to make sure that you continue to be moving in the direction that they want you to move. And that's an important point, right? That their job is to make sure that you are continuing to move in a direction that gives them an opportunity to take that dollar that they've given you and turn it into 5, 10, 15, 20, 50, 100 in a period of time that allows them to return that capital back to their limited partner. And a fundamental understanding of the fact that that is the world that the venture capitalist is living in is important in understanding who they are, what they care about, and whether you're aligned with them. Because, not all money is worth the same. And I think maybe that's That's really the important takeaway. And it's absolutely critical that your interests be aligned with those of your investor, right? And then finally, there are several other ways, other sources of funding, not necessarily the topic of today's talk, but these are also on the menu, right? There's family office and high net worth individuals. These sometimes they also operate venture capital funds. More often than not, they are, they're again just rich folks with very, very specific interests and things that they want to be a part of. And so, their investments tend to be more about personal passions, and certainly also about getting a return on the investment, but also being a part of an industry that they have either a particular interest or expertise in, or simply view as potentially very valuable. Strategic investors are larger companies in the same space as you, and they're investing in you so that they get a little bit of access to your technology, and perhaps an opportunity to acquire you at some future point. Doing business with strategic investors is really the topic of a talk all by itself. And so, we won't hit too much on the complexities of dealing with strategics today, but it's another option for funding, certainly. And then foundations, they play along the same lines of family offices. Typically, there is a synergy in terms of what you're doing and what the foundation stands for. And again, remember, foundations, typically have double mandates, right? Use their funds for the purposes for which the foundation was created, but also return money to the foundation so that the foundation can continue to do its work. And with that, I'm just going to take a quick look at the next slide. So the next slide is dealing with the flavors of instruments you might use. But I think I'll take a quick pause there, and Adam, I'll ask you if you've got any questions that'd be appropriate for now.
There's a question that came out of the last slide, and it has to do with the relationship between angels and your subsequent investors.
Yes, and great question.
Taking angel funds, and you're going to take funds later for something bigger. How are you mindful of that relationship, and how do you make sure an angel doesn't get too much of an ownership piece in the company at the early stage?
There are so many different things we could talk about on that point. Here's what I'll say. Historically, there's been friction between the angel community and the venture community. Without angels, the venture community probably wouldn't have the same opportunities to invest in reasonably well-developed, high-growth companies that they would have without angels. The companies would certainly, and at a minimum, the companies would certainly be higher risk at the time of investment. Not that all companies in this space aren't high risk, but the real challenge has historically been in angels getting run over by the venture train when the venture capitalists come into the picture. And generally speaking, there is an understanding among venture capitalists that, and I'm going to come back to the point of how do we make sure that angels don't get too much too early. But I want to talk a little bit about the interrelationship between angels and venture capitalists first. So there's generally speaking a good understanding that everybody needs to live in this world together. And without the angels, the venture players would have fewer companies to work with. And so, kind of pounding on the angels to get them to give up ownership stake or rights or the ability to participate in future rounds or even just the amount to which they're entitled in connection with the sale of a company. It's bad form for a venture capitalist to really kind of penalize the angels. Now, I am in the middle of working with a company that, I swear my head starts to swell with pain as soon as I see certain numbers come across my phone on the caller ID, because it's a situation where the more senior investor has done just that. They have completely devalued the angels that financed the company earlier. And we've been through 2 or 3 rounds with this particular investor, and on each occasion, the rights of the angels just keep getting more and more eroded in a way that really isn't respectful of the way and of the role that the angel played in bringing the opportunity forth. And as a result, partly because the investor, the more senior investor, did a really miserable job negotiating, and used counsel that wasn't particularly well versed in venture terms. What we've got is a situation where the economics have been divorced from the control. So you've got a group that controls the company that is not getting great economics, and an investor who's getting great economics but has no control. What you have is gridlock. And what you have is a lawyer's dream, because then the lawyer has lots and lots of work to do. Right? And believe it or not, we don't always want to be solving problems that do not actually create value for our clients, because as it's just not fun, right? We'd always rather work on deals that create value, that move companies forward. It's just a much better way to spend a day at work. So anyway, just coming back to the point of how do we make sure that angels don't get too much of the pie? Well, this is where instruments like convertible notes and safes can be particularly useful, because the challenge in a preferred stock financing, and this is actually a perfect question because, as you can see, we're about to talk about this. In a preferred stock financing, you need to value the company. That's the fundamental difference between a preferred stock financing and a financing using a convertible note or a safe, right? You need to value the company. And when you value the company, you are immediately fixing the amount that is held by the existing shareholders or the founders, and on the other hand, the amount that is going to be held by the investor that's coming in with new cash. The beautiful thing about a convertible note or a safe is that you're not necessarily fixing that value at this point. In fact, what you're really doing is you're kicking that job to the next preferred stock financing. So your valuation will be a function, the value ascribed to the convertible notes or the safes will be a function of your valuation at the time of the Series A. Now, in theory, that should mean that you're getting valued later, after which, and in the interim, the company's developed additional value because you've executed on your plan, or at least you're on the path toward executing, and therefore the value of the company should rise in that time. So it ends up that you're effectively giving away less of the company than you might have if you valued it at a time where you were early in development. And so those early dollars are not going to eat quite as much of your equity as they would otherwise. And that's one of the many reasons why early stage companies love using convertible notes or safes. The other main reason, and I'm going to roll right into this slide here, is that they're a fairly quick and inexpensive way to raise money. So a preferred stock financing, which again I've described as the gold standard because this is what venture capitalists rely on as a means of structuring their deals. That requires an amendment to your organizational documents. It involves the negotiation of as many as 3 different shareholders agreements, each dealing with separate terms. It requires negotiation of a fairly cumbersome purchase agreement, which is going to have a significant number of representations made by the company as to its current status. And these deals take weeks and lots of dollars to get done. Convertible notes and safes are much simpler. Generally, the approval process is a matter of doing a single board approval, and the instrument itself, the safe or the convertible note, is one document and not typically terribly long. And so, it's much, much easier, faster, simpler, and cheaper to bring in money with one of those instruments than to do a preferred stock financing, on the idea that at some future point, you will do a preferred stock financing, and those convertible notes and safes will flip into shares of preferred stock. Adam, is there another question, on these matters that'd be appropriate at this point before I kind of really keep rolling in earnest?
Been a general thought on approaches. So how
Yep.
do you approach these different types of investors? Is it the same strategy with an angel as it is with a venture capitalist? What's the best way to do that? And there's a component of this about IP and protection, but I think there's a broader concept in question here about, in our experience, what's the right timing for approaching these different groups so that you can maximize your chance of success?
Yeah, I think, you know what, Adam, stick around. Don't turn your camera off just yet, because I am going to kick the IP piece over to you for a few words. But I think that, in terms of depending on who you're asking for money and at what point you are in your company's evolution, the answer to, when should I be asking for money is going to differ. Again, you've heard me say previously, don't wait until you're at the very end of what you have, because at that point, you're almost certainly going to end up trading, rights that you would rather retain in exchange for speed. Because again, if you're desperate for funds, you're desperate for funds, and that it's a very hard negotiating position. But I think maybe what's uniformly applicable is the fact that you've got to be ready to approach the investor before you actually do the approaching, because you really only have one shot with any particular investor to impress them and to show them that you know who they are, you know what they're interested in investing in, and your company fits right in the middle of that. And you're at a place where they can easily envision how that dollar that they've given, you hope that they will give you, is going to turn into 5, 10, 20, 50, 100 in short order. And I would actually say that a fair part of that, and a fair part of the story that you're going to want to tell, will also relate to, for instance, your IP position. And that's why, Adam, if you wouldn't mind jumping in for just a moment to talk about that piece, I think it'd be this is probably a great time to talk about.
I'll give the 30-second one, which is if you're not under NDA, you got to be very careful about what you share. And it can't go much deeper than that. Venture funds are not don't easily enter into NDAs. So you have to be ready and you have to be serious, but you have to be able to give a one-page summary that'll get them interested to do that. And that's really the lesson. If you're not protected, be careful about what you share. There are a few questions here about the concerns around if you take funding for your company as a safe, is that a concern for a venture fund down the road? And if so, why is that? And how do you guard against that? Or is that a myth?
Yeah, again, another great question. So here's what I'd say on that. Safes several years ago changed from being a so-called pre-money instrument to a post-money instrument. And this is because the math behind converting a safe into shares can be really, really, any sort of convertible security, I should say, whether it's a safe or a convertible note. They're both, the math can be very, very complicated. And that's because in calculating the number of shares that your safe, your pre-money safe converts into, you also then have to model out the actual conversion of that safe and every other safe in the process. What Y Combinator, realizing this, has done is that they've moved to a post-money safe. So rather than calculating, the number of shares into which a safe will convert as a function of the value of the company before any funding is taken, they now do it after right? So it's much easier to understand as you're selling the safes what the maximum number of shares a given safe could represent after you've done your Series A. Now, how does this relate to what a VC might be concerned about? Well, perhaps the most one of the we'll just say it's one of the most critical points in a VC's analysis of whether a team is poised for success is, are they sufficiently motivated to succeed? Now, presumably, all of you are very, very excited about the projects that you're involved with, and otherwise, why spend your time on them? So that's part of it. But the other part is making sure that you're in line to get rich if things work out really, really well, right? And in order for you to have great economic success out of your startup, you need to own enough of the startup to ensure that, once the company is sold, there is enough money heading your way to justify all of the toil and stress that you have that you've gone through up to that point. So where investors get where venture investors get nervous is if you've given away too much money in the form of pre-venture investment. And I shouldn't say given away too much money, it's really given away too much of the company in terms of the number of shares that those instruments will convert into. Then venture investors can get squeamish about what your cap table is going to look like, and whether you as a founder team are going to be sufficiently incentivized to continue to take this all the way through. And so it's a bit of a balancing act. And this is, again, another place where your advisors should be coaching you in terms of what is a reasonable amount to raise under a safe, and at what point should you be looking at doing a preferred stock round, just so that you can fix a valuation and so that you have a sense as to how much you're going to retain following your Series A.
Excellent. So 2 more questions before we move on. We can maybe
Great.
answer in short order.
Yep.
But there's some other highlight differences between convertible notes and safes that people should be aware of. And is there a downside to raising money using common stock for early investors? And then we can move on to the next slide.
Excellent. So let's talk about the difference between convertible notes and safes really quick. So, Y Combinator did everybody a favor when they created the safe. And here are the advantages, and through the advantages you'll get a feel for the differences, right? A safe is, first of all, a standardized document. When you raise money using a safe, generally speaking, you're using the Y Combinator document. You are not making significant changes to it, and to the extent you do make significant changes, it's a term of the safe instrument itself, or at least I should say the copyright of the safe, that you call out any such changes in a very obvious way. So what they've done, what YC has done, is they've created a mechanism whereby everybody's starting from the same place. And this is also a feature of venture financings, right? Because everybody uses the National Venture Capital Association documents as a basis for your Series A transaction docs. And so now we've got that same standardization at the safe level. Convertible notes can be different depending on who's drafting it. I have a form of convertible note that I like, that in some cases is wildly different than other convertible notes drafted by other practitioners. The other, another difference is convertible notes fundamentally are debt. Debt generally requires an interest component. And so your investor may end up increasing the size of their investment merely by holding the convertible note itself. Safes do not have interest. No interest accrues on a safe. I think those are really the major differences. And again, I would say on balance, I am certainly of the mind that a safe is a much easier transaction than a convertible note. The standardization is a really great feature. And we've gotten to a point where people are comfortable enough using safes and accepting safes and understanding what they are and taking comfort in the fact that the terms are standardized, that not only are they in use across the US, but we see safes out of our London office in European financings as well. So again, it's a great instrument, it's a great tool. I like them a lot. And then in terms of raising using common stock, if you can get away with it and the valuation is reasonable, then by all means. Again, remember the challenge with, first of all, venture investors are always going to want preferred stock because they need the rights and the preferences. Preferences is the order in which funds get repaid on an exit transaction. I shouldn't say repaid, but the way that they're paid out to the stockholders in connection with an exit. Preferred stock gets a piece of the proceeds first, typically equal to the amount of the purchase price of the preferred stock, right? And so that's an important characteristic for professional investors, for the shares to have. I generally see common shares being sold in connection with a friends and family round. Again, it can be a very, very simple, cheap transaction. All the things that we like about safes can be done through common shares as well. Again, it's just a matter of, does your investor have the appetite to buy common stock, as opposed to a safe, which will ultimately get them the same rights that are negotiated for in connection with that next preferred stock or that first preferred stock offering. So they're going to piggyback on all of the benefits that the venture investor has negotiated for. And that's a really important thing, particularly if you're trying to make sure that your friends and family are well taken care of. So with that, let me keep rolling, and I will stop again for questions as we go. So things to consider as you're raising funds. Again, we've talked a bit about how to choose a corporate structure and an instrument that reflects your needs at your time in development. Again, as I said, you're not going to become experts on venture financing today. I am simply, more than anything else, trying to get you to understand when it is that you should be seeking advice from people who do this. And there are lawyers, there are financial advisors, there are others who simply have seen dozens and dozens and dozens of deals, who have a good sense as to how to match up what you're trying to do with an appropriate funding strategy. So again, matching the amount that you're raising to need and future considerations. No one ever wants to raise more than they actually need or can justify based on their valuation at that time that they're raising, because any extra that you raise is just going to deplete your holdings in the company, right? Because it's a bit of a zero-sum game. At the beginning, you start out owning 100% as the founding team. It only goes down from there as you take in investment from outside parties. And so, frankly, you just don't want that to dip any lower than it needs to at any given time, which is why having budget plans and thoughts around how you're going to use your capital and what it is that you're trying to do with the capital you're raising, and how it is that you'll know whether you've achieved those goals. Those are all really important considerations and the kinds of things that you're going to want to communicate to your prospective investors. And again, it just goes to making sure that you're retaining as much of your company as you can and should. Matching investors to your outlook for the business. So again, we talked a little bit about this in terms of the difference between, say, a family office investor or a venture capital investor, in that, your VCs professionally, their whole reason for living is to increase the value of the assets that they are deploying from their fund into your company. So they are truly, truly fixated in how it is that you're going to return more than they gave you. And some venture investors are, I guess I'll say better than others Some have longer time horizons. Some have specialties in their industries that lend themselves to making sure that you ultimately get acquired by a complementary company doing, something that again is kind of clear that this very well could be an exit that you wouldn't have had an opportunity to look at were it not for your investor. And it's exactly why I have the next point, which is identifying capital that can do more than simply financing the business. I said before that venture capital is the most expensive money you'll ever raise. And that's partly because of the rights that they will ask you to give up and the obligations that will be put upon your company by these investors who want to make sure that they're generating a return. But also the flip side of that is that a good venture capitalist should be able to create opportunities for you, both commercially and from a business development perspective. And business development perspective means potential acquisitions or other business opportunities that you wouldn't otherwise have had without their involvement. So, that's a very, very easy way that a venture capitalist can return value to you, that has nothing to do with the amount that they put in. And it's much more about who they are, who they know, and what else they're involved with. Ability to follow on. This is actually an important point in the distinction between, say, an angel and an institutional venture capitalist. One of the things, as you think about the rights that you're willing to give up in order to get a deal done, is thinking about how many more times you're going to need to go through this exercise and how many more times you're going to be thinking about what rights am I willing to give up and how much of my company am I willing to sell to somebody else. Well, if you're lining up your first financing with an investor who is going to be there for your next financing and the financing after that, because that their fund has a fair bit of dry powder. And by that, I mean they have money to invest and they've got a decently long time horizon and they're prepared to ride with you through your journey. That's a much different exercise than negotiating with an investor whose fund is kind of at the end of its term and, or they say something on their website to the effect of, we tend to invest in Series A's to a maximum of X dollars and we don't tend to follow on. I have never understood investors who publicize the fact that they don't intend to follow on, other than that they're really kind of doing the entrepreneurs a pretty big favor by telling them that. Because at the end of the day, if you think you're going to need more than one round of financing, you should be thinking long and hard about whether you're interested in going with a fund that at the outset is only going to be around for one round. Because raising money is a lot of work and it takes a lot of time. And, I probably don't need to tell a room of entrepreneurs. No, I don't need to tell a room of entrepreneurs that making a single sale that then results in recurring business is a lot more efficient than making individual one-off sales, right? And that's really the thinking behind making sure that your investor, to the extent that you think you're going to need multiple rounds of financing, that they're going to be with you for those multiple rounds, because it's just going to make your life easier later on. Finally, again, none of this is Shark Tank. It never works fast. It never works simply. This always takes longer than you think. And so be prepared to have long conversations with your investors, your prospective investors, with other companies that they have invested in. Expect that they're going to want to know everything that there is to know about your company, and they're going to engage in pretty significant diligence. And simply be, as prepared as you can be for that process. Adam, I see you've popped back onto the screen.
Yeah. What are some of the things to consider? What are some of the pitfalls that people need to be aware of, and particularly in connection with raising an A? So what are the pitfalls around raising an A that could be problematic as you move to a subsequent round of financing?
Sure. There are lots and lots of things that can make this more difficult than it needs to be. I've already kind of raised the point of making sure that your investor and where they are in their life cycle is aligned with what your needs are, both now and going forward. A mismatch in that respect is, can be really troublesome, because once the money's in, you're married, right? The investor isn't going anywhere. And then, the other thing is making sure that, what it is that they're interested in and the way in which they work with their portfolio companies is something that is akin to the way that you envision how it is that your investors should be working with you and the opportunities that they should be bringing to the table. And there's no better way to do that than to talk with other companies that have been invested in by a given investor. I mean, we check references for everyone all the time. There's no reason that you shouldn't be checking references for folks that you're talking to if they're seriously looking at making an investment and you're seriously looking at bringing in their money. Sam, I see you've popped on. Do you have a comment or a thought you want to share?
I couldn't echo more strongly what you just said. When you're taking in new money from investors, you really are taking in a new partner. And the way that a lot of these A rounds work is the investors will get power to veto very significant decisions that you want to make as a company, whether it's a capital expenditure or an acquisition or a new round of financing subsequent to the A round. They have veto rights over all that stuff. And that's really critical, that you really understand how those investors think and that you're on the same wavelength with them. And I've had many clients that have been fortunate to be looking at 3 or 4 different term sheets, from 3 or 4 different reputable VC firms. And they the counsel that we give is is this the person that you want to be in a conference room with late at night on a Saturday working on a problem? Because that personal chemistry is really important. And trusting someone's really important. And you really should just think carefully about those issues. One other point I'll make, and then I'll mute myself back, is the other questions that you should ask are, who else invests typically with these investors? Because very often you'll see venture capitalists go in groups or clubs. And it's, you can get some real power from the initial venture capital fund who comes in. If you understand, oh, geez, if this person invests in me, very likely the next round, they'll bring these other 4 funds with them. And that's a really powerful thing to think about, especially if you're in a business that is going to require a lot of capital to get where you want to go.
And so, Michael, the other question we're getting is on the founder's side, and how should they structure that equity, and are there concerns that founders need to have around how they structure their relationship with the company that could impact the oncoming investor?
This kind of harkens back to the point of, you really can't start preparing for fundraising early enough, because I guess the most important thing that you'll find is that you don't really get a second opportunity to reimagine your initial distribution of equity, right? It's critically important that your founder arrangements that are set up at the time you organize the company are going to meet your needs for the foreseeable future, and are sufficiently flexible that if circumstances change, you're able to kind of adjust those arrangements in a way that makes sense. So a perfect example is vesting of founder equity, right? Because at the very beginning, everybody's very excited to be in a given project, and that there's lots of good momentum, and then life gets in the way, and people find that they have different things that they want to do, different needs that they need to focus on. And the life of an entrepreneur can be very difficult and stressful, certainly. So, having a vesting arrangement ensures that, if one of the founders leaves, you don't have a third or a half of the equity walking out the door and no longer contributing to the benefit of the company, right? Because that's the kind of thing that an investor later is going to look at and say, I don't understand how it is that this person who hasn't been here for the last year, is still in line to get 33 cents out of every dollar that, that comes out of an exit transaction. That doesn't make any sense. And so again, it's, all of this comes back, and it sounds terribly self-serving, but it's true. Again, no one is going to become an expert in venture financing overnight. And you don't need to be, right? I mean, no entrepreneur needs to know the ins and outs of every venture term, right? Every subsection of the safe, how many rights you get to do X, Y, and Z in the voting agreement or what have you. That's my job, right? My job is to highlight for you the things that you need to care about at each stage of company development, leading up to and including the financing, and then afterwards, right? So, I mean, I really can't say enough that having good advisors is just so critical in this process, because, we've all seen, dozens and perhaps hundreds of examples of deals, some of which have gone better than others. And it's, it's pretty easy to point people in the right direction. It's actually easier to help you avoid the pitfalls on the fly than to list out every pitfall that you might end up falling into. But again, maybe the most important piece is just to make sure that you're getting advice along the way that helps you put yourself in the best position to have a successful fundraising. And then that, every time you take a corporate action or you make some sort of arrangement, that whoever is doing the work for you is thinking about the next person who's going to be looking at these documents. Because whether it's an investor doing diligence in connection with a financing, a potential acquirer doing their diligence in connection with a potential acquisition, or an underwriter doing their diligence in, as you're looking at doing an IPO, someone is going to look at all of this paper and is going to try to understand what it is that you were thinking as you put all of this together. And so gearing what you're doing around making sure that everything that you're doing is going to help you and not be an impediment to what it is that you're looking to do next, then you're ahead of the game. And with that, I know we've seemingly come to the top of the hour, so I will take a breath, and I'm going to bring the slides back to to our beautiful pictures, which also have our contact information on them. And we would all be very, speaking on behalf of my colleagues, we'd be very happy to answer follow-up questions and to talk to you about your individual circumstances. Should you have a desire for assistance. And with that, I guess I'll just ask my colleagues if either of them have anything else to say on the way out the door.
Great job. And I'll turn it over to Christine.
Well, thank you so
Thanks,
much. Thanks for your time. And this record is recorded, and we'll share this slide with everybody once we have it all ready to go. So with that, thank you. We've finished on time.
Thank you, Christine, and thanks everybody for participating.
Thank you for everybody's time. Have a good afternoon.